How does the discount rate affect interest rate decisions? Have you ever wondered how the discount rate influences the interest rates you see on loans and savings accounts? Let's break it down in a straightforward way. The discount rate is the interest rate set by a central bank for commercial banks when they borrow money directly from it. This rate plays a vital role in shaping the overall economic environment. When the central bank raises the discount rate, borrowing becomes more expensive for banks. As a result, banks typically respond by increasing the interest rates they charge to businesses and consumers. This means that loans for cars, homes, or businesses will cost more. Higher borrowing costs can lead to reduced spending and investment, which may slow down economic growth and help control inflation. On the flip side, when the central bank lowers the discount rate, borrowing becomes cheaper. This encourages banks to lend more money, which can stimulate economic activity, especially during tough economic times. Lower interest rates can lead to increased consumer spending and business investments, helping to boost the economy. The discount rate also plays a key role in guiding short-term interest rates in the financial system. For instance, it influences the federal funds rate, which is the rate banks charge each other for overnight loans. Banks usually do not borrow from one another at rates much higher than the discount rate. Therefore, the discount rate effectively sets a ceiling on these market rates. By adjusting the discount rate, the central bank can help keep short-term interest rates within a target range that aligns with its monetary policy goals. These goals often include maximizing employment and maintaining price stability. From a broader economic perspective, changes in the discount rate send signals about the central bank's stance on monetary policy. An increase in the discount rate often indicates a tightening policy aimed at curbing inflation. Conversely, a decrease suggests an easing policy to support economic growth. These signals can influence expectations about future interest rates, impacting financial markets, consumer behavior, and business decisions. In practical terms, the discount rate affects several key areas. First, it influences bank lending costs. When the discount rate is high, banks face increased costs, leading to higher loan interest rates. Second, it affects credit availability. Higher rates can make banks less willing to lend, tightening credit conditions. Additionally, the discount rate impacts economic growth. By influencing borrowing costs, it indirectly affects consumer spending and business investment. It also plays a role in inflation control. Raising the discount rate can help slow inflation by cooling demand. Lastly, the discount rate helps maintain financial market stability by anchoring short-term interest rates and preventing excessive volatility. In summary, the discount rate is a central tool in monetary policy that shapes interest rate decisions across the economy. It affects the flow of credit, economic growth, and inflation dynamics, making it a key factor in understanding how interest rates are determined.